Hey, it's Tom here and welcome back to the channel. It is monthly Q&A time here yet again. I think I'm a little bit late on this one. This is the second Q&A video for 2023 and I put a community post up here on YouTube a few days ago to collect your questions for this video. So thanks to everyone who did ask a question. I'm going to try and get through as many as I can. Apologies if I don't get to your question, and just if you're interested in asking a question in a future Q&A video, be sure to keep an eye out for my community posts here on YouTube. You should be able to turn notifications on for the channel so that you can see each time I do put up a new community post, and that way you can get in quickly, ask a question, and hopefully get that question included in a future Q&A video. But with all that said, let's get straight into answering some of your questions. Okay, so first question here is from Alan. Hey Tom, thanks for all the excellent videos. Thank you very much. My question is about long-term planning. When you reach the size of portfolio that lets you retire, how do you plan around withdrawing from that portfolio as your future income? Fits well with the quote you put, haha. Yeah, good question. I mean, I am a fair way away from that point at the moment, so things will potentially change, of course, when I get there. But the way I'm sort of thinking about that potential target kind of portfolio value at the moment is just using a really basic rule like the 4% rule. If you invert that, simply kind of take an amount of money that you think you might want to live on and multiply it by 25, and that's kind of the portfolio value you probably roughly need to be at for it to be sustainable. So what I mean by that is I might withdraw, say, 4% of my portfolio value each year for living costs. Hopefully I'm generating returns greater than 4%, so the money at the very least kind of stays constant, the portfolio value over time, but ideally is still kind of compounding away. So how that looks in practice moving forward, I expect probably some of that 4% will just come from dividend income. I'm certainly no dividend investor, but if I had maybe a 1% or 2% dividend yield on the overall portfolio from having some larger dividend payers in the portfolio, I think that would get me part of the way to that 4% kind of drawdown on the portfolio each year. And then maybe I need to sell 1 or 2% or 3% or something of kind of the principal balance of the portfolio each year to get that, full 4% for living costs. I think if I can manage it that way, that should still allow me to have a structure to where I can still compound the portfolio over time and kind of just, keep moving forward over and above what I need for retirement. But that's the way I'm at least thinking about it right now, but a long way to go just yet. I should mention that I think that's really the way that Warren Buffett has deliberately set up his sort of charitable giving over time. He's given a lot of money to various charities, most notably the Bill and Melinda Gates Foundation over the years. And the way he sort of structured it is he's gifted Berkshire Hathaway shares, but typically the shares have appreciated each year kind of more than the amount of shares that he's given away, if that makes sense. So he might be giving away, say, 1 or 2% of his net worth, or 3 or 4% of his net worth each year in shares. I'm not sure exactly what that is off the top of my head, but Berkshire stock has been appreciating at a greater rate than that rate of giving. So even though Buffett has given away a huge amount of money at this point in the form of those Berkshire shares, he's still sort of compounding over time because the growth engine of Berkshire is growing at a faster rate than the rate of giving. Next question here is from And Ray. Hi Tom, considering the importance that Charlie Munger assigns to learning the most important concepts in all the disciplines in order to facilitate our understanding of the world, are there any mental models that you've been able to extrapolate from your day-to-day job or even personal experiences? Thank you for your work. It has added a lot of value to me. Thank you very much. I always like to hear that. I guess in terms of understanding like the major concepts and all of the major disciplines, I think I've got those bases actually pretty well covered just through my education. I've got a pretty strong science background, so have a fairly good understanding of the fundamentals of biology and physics and chemistry. I'm reasonably decent at maths, not amazing, but pretty good. So I think that helped me along kind of that path just in terms of understanding all the big like academic areas. There's other things that you just pick up over time. Like before I was even remotely interested in saving money and investing, before I even had my first job, it was pretty abundantly clear to me that if you want to get ahead in life, you have to get equity in something. In my personal life, kind of the people around me that had done really well financially, or at least that I expect are doing very well financially. I don't know their personal finances inside out, but typically they'd gotten equity in either a business or real estate or often a farm. That's kind of, there's a lot of that goes on in New Zealand as well. So it was pretty abundantly clear to me that you've got to get equity in something somehow. For me, that's been through real estate more recently, but also predominantly through shares. So that's sort of a mental model I picked up very, very early on. There's other lessons that you pick up all the time. I feel like I've got a good understanding of accounting these days. That's something that kind of continues to develop for me. I understand compounding pretty well. I understand, the merits of cloning other people with good ideas pretty well. And there's countless others that I won't rattle off for half an hour in this video or anything. But those are a few of kind of the key experiences, I would say, that have really pushed me, hopefully, in the right direction. And next question is from Luis. Which of your stock portfolio businesses do you feel like you'd be the best at running as a CEO if you had to start today, and which would be the toughest? That is a very good question. I think across probably most of the portfolio, I think I could do it. This is probably like a good mental model, I guess, or a bit of a mental test to run through your mind around how well you actually understand a business. Because if you feel like you could do a half reasonable job at being the CEO, that probably means you have a pretty good feel for how the business kind of works fundamentally. I think there's some that'd be probably pretty straightforward, like Seritage Growth Properties comes to mind, which is just a bunch of real estate they're trying to liquidate. I'm certainly no seasoned real estate deal maker, but I think I could do pretty well there. Even like a Berkshire Hathaway, it's obviously a super complex and very large business at this point, but I feel like, at least as I understand it, Warren largely sits in a room all day and just reads about business and stocks and, chats to the CEOs of the businesses. So I think I could do pretty well in some of those types of companies. The one that I think I would struggle the most with would be like an Alibaba. I think that's probably just more of a local culture kind of barrier. I feel like there's a bit of understanding I would certainly have to gain there to do a good job running a big business like Alibaba. But I think pretty much every other stock in the portfolio, I could do a decent job at kind of running the business. I feel like I understand all of them pretty well at this point. Question here from Thomas, a relatively simple seeming question, I think, but a rather complicated answer here probably. When to sell a company? I think selling is much more difficult than buying. You generally buy a stock because you have confidence in the underlying business and confidence that you can value it, and you think it's cheap relative to its intrinsic value. That's a pretty straightforward equation. Selling a company is much trickier. I think there's some obvious points in time where you probably should sell. One is if your underlying thesis is just flat out wrong, you should probably cut it there and move on to the next thing. But beyond that, it becomes a little more difficult. So, you could say that you should sell something when it gets up to intrinsic value or when it gets overvalued, for example. That certainly makes sense in theory, I think. But there's other things that you have to consider. What are you going to do with that cash once you sell the stock? Are you just going to leave it in cash, or do you have somewhere more intelligent to allocate that capital? Are there tax implications of selling that particular stock that might, hold you back from doing so? There's a lot of kind of competing factors that would go into that decision. But generally speaking, I would say, one, if you've made a mistake, or two, if the relationship between the market price of that particular stock and its intrinsic value is not particularly attractive, as a continuing long-term investment. Next question here is from Kunet. Hi Tom, question from Norway. Thank you very much. We have a relatively global audience here on the Investing with Tom YouTube channel. It's quite cool to see. Have you ever invested in a cyclical business, and do you know anything about investing in one? Can cyclical be value investing also? Can cyclical be value investing? First of all, I think yes, certainly. Anything where you think you're buying the company for below its intrinsic value is value investing to me. And it doesn't even have to be a company. It could be a stock, but it also could be a bond or a private business or a bit of real estate or whatever. Anything where you are buying below intrinsic value is value investing to me. Cyclicals can definitely fit in that basket, but I think the issue you're going to have is oftentimes estimating intrinsic value becomes more difficult because if a business is cyclical, it means that the future cash flows are far more difficult to project. I have invested in a couple of cyclical businesses in the past. I still have at least one that's in the portfolio now, which I plan to hang on to for a long time. And I think there's a couple of ways you can sort of analyze it. One is if it's like the textbook kind of cyclical business, like a commodity company, for example, where commodity prices swing around wildly and the earnings of the company swing around wildly. I think you can look for a couple of things. So one, you can say, even if commodity prices are really low, is this still an interesting investment? Are the earnings still enough to warrant the price that I'm paying? And then if commodity prices normalize or go really high, then are we just going to print money hand over fist? I think if you can get into that sort of no real downside but a lot of potential upside scenario, that's kind of a good way to go. That's kind of saying, I don't necessarily know what intrinsic value is, but I certainly know it's not below this level. There is a certain floor to intrinsic value. If the market price gets under that floor, that can get really interesting. By a similar token, some more cyclical businesses might be not so cyclical in the short to medium term. Maybe they have a bunch of contracted revenue that helps you get a lot of kind of money back and cash off the table, pretty quickly into the life of that investment. And the other thing you could look at is, maybe if the earnings are going up and down all the time, perhaps you could still fall back on some sort of physical asset value. So for an oil company, for example, the earnings are going to swing around all over the place, but that oil company is probably going to have a lot of physical assets that'll make up some part of their overall asset value, but they'll also likely have a lot of proven reserves in the ground. And oil companies specifically actually have to publish things in their annual reports, like a standardized measure or a PV10, which are a couple of different ways of estimating the value of their reserves. So a couple of different options there. One is to focus on earnings and try and buy at a price where even if earnings are not great, you're probably still going to do okay. Secondly, you can have that kind of asset value to fall back on as well. Question here from Avye, where can I find your SRG valuation, property by property, if you have one? Thanks. If you just go back to a video probably from last year at this point, called something like Seritage Growth Properties Intrinsic Value, I'll try and link it up in one of the corners, should be linked in the description of that video. I must say I'm pretty overdue to do an update on those valuations, so they are a little older and perhaps slightly optimistic, so keep that in mind, but that's where you can find that one. Question here from Caleb, what do you look at when determining whether a company's debt is manageable or not? And what qualitative aspects help you know if they can handle the debt? I guess, for me that's mostly a quantitative question, but just quickly on qualitative aspects, that would be something like, because it's really about projecting for the future earnings versus their future debt obligations. So they're going to generate the cash to be able to pay interest and principal payments on the debt. So there's a few qualitative things that can certainly impact the future kind of cash flows, and they're probably qualitative things that you'd look at for most businesses anyway, irrespective of debt, things like a moat or a competitive advantage, but also things like maybe operational leverage. So if revenue goes down a little bit, earnings going to go down a lot. That's kind of what operational leverage is. So that's maybe more of a qualitative type thing you could look at, but it's largely quite quantitative. It's really how much cash do I think they're going to produce, how much cash do they currently have on hand, and what are their debt obligations. And ideally, they're producing enough cash flow to cover their annual debt obligations many, many times over, and you've got some safety there. The other thing I pretty much always pay attention to now, particularly if the company has a lot of debt, is to just read the annual reports and see what the debt maturity kind of profiles look like. Most corporate debt is structured in a way to where the company will just pay interest payments on a bond that they've issued, for example, for a long period of time. It's not like, a mortgage on your house, for example, where you're paying principal and interest the whole way through. Usually a company is just paying interest, each and every year, and then they'll have this big balloon kind of payment of principal that will be due on a given date. So you can find those those debt maturities and when those big principal payments are due in the annual report. If they've got big payments coming up in the next year or 2 or 3 years, you'll definitely want to do some kind of careful calculations on whether you think that the company can meet those debt obligations. And occasionally you can run into some weirder situations as well. Take a Seritage Growth Properties. They've been liquidating a real estate portfolio to generate the cash they need to meet debt obligations. So that one was less about the cash flow, generation of an underlying core business. It was really about trying to liquidate real estate and, what price you think they can get for the real estate and how quickly you think they can sell the real estate. So, different situations require slightly different types of analysis. But there's some of the general things I think about, and as always, if you find a company with less debt, it's likely to be a bit lower risk than a company with a lot of debt. I think that's a general rule of thumb that most people will agree on. Question here from Jerry VDW. Looking forward to the Matt Peterson podcast. When will you be releasing it? Thanks. Good question. It should be out in the next couple of weeks, hopefully. I still haven't recorded the podcast. We've pushed that out a little bit, given some of the earthquakes that have happened in Turkey recently. Matt has, family in Turkey, and he has some stock holdings in Turkey as well. So just kind of out of respect for that situation, we pushed the recording date out a little bit, but I'm very excited to record that episode with Matt, so definitely keep your eyes peeled for that. Let's take one last question here from Sten Hemming. Tom, thank you for the great content and congratulations to both of you on becoming parents. Thank you. I did just become a dad recently, for anyone who's not familiar. I have 2 questions. 1, are you working on expanding your circle of competence? How do you handle that? And 2, how do you go about tracking your investments, e.g. notes system? Let me take the second one first. So in terms of tracking my investments, I track my returns just in ShareSite. That's always linked in the description. I've been using that for years at this point. It's the software you will see in the Shameless Cloner portfolio videos. Gives you, capital gains or losses, currency fluctuations, dividend income, and a whole bunch of tax reports. It's genuinely extremely useful. So that's what I use for tracking returns. Other tracking systems I do use an investment checklist anytime I'm looking to make a new investment or even add to an existing investment. So I've made videos about that here on the channel before. I simply just have those in Excel spreadsheets, but those can be quite cool to look back on and useful to look back on at different points in time. So, stocks I added to last year, for example, I will have an Excel spreadsheet with a bunch of notes and all of my checklist results saved away for at that point in time last year, and I can go back and look at the things I was thinking about at the time, whether the thesis has really played out and that type of stuff. And in terms of working on expanding your circle of competence, how do I handle that? Largely, I think it just kind of expands naturally, just with interesting companies that might pop up, and continuing to learn about companies that I already own. I think it sort of just expands naturally. Occasionally, I do read something industry specific that's very new just to try and expand my circle of competence. The Bank Investor's Handbook I read last year is a good example of that, to get a good introduction into banking, but I try not to force it too much. I don't think you need to be super competent in a million different industries. I think if you can get your head around a small number of them and understand them very well, that's probably more than sufficient. Okay, so those are all the questions we have time for in this video. Thank you very much to everyone who did ask a question, and thank you very much for watching the video. I really appreciate the ongoing support over the years on this YouTube channel. Like I say, if you're interested in asking a question in a future Q&A video, just turn notifications on for the channel. Keep an eye out for community posts, and about probably a month from when you're seeing this video, you'll see me try and collect some questions for my next month's Q&A. So that's all I've got for this one. I hope you enjoyed the video, and I'll see you in the next one. Cheers.